Good afternoon, everyone. Thank you for joining for this afternoon's webinar. My name is Ashley Nellie Davis. I am Vice President at the Data Foundation. The Data Foundation is a nonpartisan organization based in Washington, D.C., that champions the use of high-quality data with the support of grants, philanthropy supporters, and our Data Coalition members. Our team leads research and collaborative initiatives like the white paper Tom and Kirk have put together to build a better future through practical policies that ensure data and evidence are accessible and reliable. For over a decade, the Data Foundation has worked closely with the data community through convenings, supporting the passage and implementation of foundational data laws that include the Digital Accountability and Transparency Act, the Evidence Act, AI and Government Act, Financial Data Transparency Act, and others. These laws and our efforts aim to advance and support data access, management, and use for better government and society. Or in another way of looking at it, we are in the business of supporting the building blocks and infrastructure of federal information, how it's captured, reported, managed, and accessed. In doing so, we work to ensure stakeholders, whether it's private citizens, agencies, Congress, investors, financial institutions, or municipalities, have access to reliable information. Today's webinar, The Impact of Data Quality, Data Standards, and Fraud Mitigants in Private Markets, with co-authors Tom Dunlap and Kirke Cushing, highlights the growing need for such information and how to build an environment for that data. Before we get started, I would just draw your attention to the chatbot where we've put in some of the housekeeping items, including where to submit your questions, if you have issues with Zoom, who to reach out to, and we hope that you engage with today's information. Once I introduce Tom and Kirke, they'll provide a brief overview of key points from the white paper. We'll provide a link to the white paper if you haven't accessed it yet. And then following that presentation, we'll have a guided discussion followed by time for Q&A at the end. So we do have time for your questions. Thank you again for being here this afternoon. I'll introduce Tom and Kirke, and then we can get started. So co-authors Tom Dunlap and Kirke Cushing represent their advisory and consulting firm, DIACSUS. Tom is also a senior fellow with the Data Foundation. Together, we commissioned this report based on trends that Tom and Kirke were noticing in the financial sector, a place where data standards could help clear growing information gaps and needs. To give us more insight, I'll just go ahead and turn it over to Tom and Kirke for a few minutes.
Okay, terrific. Thank you, Ashley, for that. And it's just terrific to be with you all today. Thank you for joining this webinar. So we'll take about 15 or so minutes to discuss some slides here on the topic, and then we'll have some Q&A with Ashley following that. So what really is happening in the private market space, and why should you care? Well, a ton actually over the past recent years. Investor types have evolved to include individual retirement plans, often through asset owners such as large pension plans, 401ks, and even retail investors. This is no longer an asset class for institutional investors, and changing regulations have also been an enabler of these additional investor types. Asset under management is at 15 trillion and growing across asset classes that include private equity, private credit, syndicated loans, and real estate investment trusts, amongst others. However, amongst all that growth, there's a lack of good data coverage and quality, along with data governance, and for that matter, regulatory environment for which standards have not kept pace. So these, coupled with high data latency, manual processes, and workarounds, are really straining the industry to keep up. 90-day reporting lags are really the norm. Yet the industry is ready for a change. They're actually pushing for an improvement. And these collective factors are what led us to developing this white paper. Just pause for a moment, Kirke, and see what else you'd like to add before we continue. Kirk, you may be on mute.
I am on mute. Sorry about that. I would add that this is growing, this number, this $15 trillion number, because of the desire for diversification. But as Tom will discuss momentarily, also because of the entrance into retirement accounts and retail investment space into the private markets. Next slide, please.
Thanks, Kirk. So let's take a moment to compare and contrast how public markets differ from private markets across six key criteria. The first, disclosure obligations. So these are required in public markets. These are often voluntary and ad hoc in private markets. They're often being sought by limited partners from the general partners. Second, around identifier standards. These have been the standard for years within public markets. Think CUSIPs, ISINs, FIGGIes, and other identifier types. For private markets, they exist, yet they're voluntarily applied. It's also similar to legal entities, such as the legal entity identifier. The third, around regulatory oversight, it's vigorously and rigorously applied within public markets, yet more limited in private markets. A well-known example would be the SEC Form PF, which is for registered advisors. Really not too much beyond that. The next element around investor eligibility, broadly open to investors due to marketplace transparency within public markets, becoming more open to more investor types, yet market transparency is lacking within private markets. And this is a key reason that financial services professionals are pushing to be more public markets like. That transparency and standards and data are key enablers for better and more timely data completeness and quality that drives the functional outputs. The fifth around data centralization, think DTCC, the Depository Trust and Clearing Corporation, and pricing transparency as examples within the public markets product space. In private markets, most transactions are bilateral between counterparties and exception-based. And then the sixth element is around pricing, valuation, transparency. It's very open, very transparent with real-time values on most asset classes. In the private markets, there's an expectation of periodic general partner calculated and limited partner evaluated net asset values figures. There's little mark-to-market actually taking place. Kirk, what else would you add?
I would just add on that last point, Tom, that as you and I have discussed before, it's interesting that it's now a 90-day delay. It's the one asset class that we've seen delays go longer. I think we can both say that about 20 years ago it was a 30-day delay, right? So that is one of the reasons that this has become, I think, so much at the forefront of our discussion. Next slide, please.
We went into this study for the white paper, knowing that the private market space exists for investors on purpose to seek out products and entities that have higher payout potentials with some accepted friction and a longer time frame to recognize a financial gain, ideally. The problem is that these investors that are entering into the private market space, such as retail, the 401ks, the other retirement plans, and so on, they are expecting something that's more timely and more time bound and probably have less sophistication as the traditional institutional investors. So there's a desire to narrow the gaps, and in particular, you need to have higher data quality to do so. So we want to keep the private markets intact, yet what really needs to change? What are the risks? So we identified six risk factors that you see here on the slide. First, around data quality and timeliness. I think access to the data, timing, and the accuracy. This data is often held by the companies directly. The general partners have to be able to obtain that information. From an operational and compliance risk perspective, the limited partners will reconcile, validate that information. They'll go to fund administrators, to custodians, sometimes even companies themselves, or do different searches that they must perform. So completeness and scope must be fully captured. There's also an element around fraud and payment integrity. These are related to know your customer and anti-money laundering needs. Are the investors legitimate and whom they say they are? How do you perform these prepayment verification checks, which is already a weakness, if you will, within the financial services industry, at least in the US. Beneficial ownership. Do we know the ultimate beneficiary? More and more payments are transacting through digital currencies, yet there's still a need to know that ultimate beneficial owner. And that is because it's related to the KYC and AML requirements. Those don't go away. There's the linkages to digital assets. Again, cryptocurrencies being payment types for these. And then artificial intelligence. We can have a discussion about that. It can actually amplify the weaknesses. So I literally just got off a call a moment ago, speaking with a regional investment advisor firm that just talked about the challenges they have there. Quality of the data can be poor. That input can result in hallucinations with AI. The training by AI gets learned on that poor data, resulting in associated poor outcomes. And then there are reasonability checks and there are suitability checks and so on that take place. So how do you integrate this all? And this actually becomes both a governance and a data quality problem. And then how do you protect your intellectual property, let alone client protections as well? So should you be worried? Yes and no. And we'll discover that in a bit more. Yes, if nothing is done. No, because the industry is pushing for change. Kirk?
Right. I think that the three things that I find here, number three, four, and five, very interesting is because four and five, the opacity of the beneficial ownership. If you think about that, like the Russian dolls, right? So you have the first doll might be a Cayman entity, the second might be a limited partnership, the third might be the family office, for example, and on and on and on. So all those dolls together, and for the reason I bring it up is for completely legitimate reasons. It's set up like that for tax reasons, for estate planning reasons, that type of thing. But it's also the same way that it would be set up if it was, nefarious, right? If somebody else was trying to come in. So it makes the traditional KYC more challenging in this space. And then the same thing with the digital asset linkage, right? So all of the things that are being done on the digital asset and crypto exchanges and those assets coming into this marketplace can be done for either legitimate reasons or not so legitimate reasons. So that's what I think is one of the bigger challenges that we come across in this space. Next slide, please.
Okay, so the target state for remediation. So within the near term, we came up with some recommendations. And this is actually something that we intend to bring towards Congress and the executive branch at some point. Voluntary safe harbor around standardized definitions of data labels, not the economics. So what do we mean by that? So some pretty straightforward views around nomenclature, around identifying common points of view around the wording that's used, the fee schedules that may come up. But what we're not trying to suggest is that the deal economics get disclosed, but rather a common way of having systemically applied across the financial services industry terminology, definitions, and so on. We're less interested in the economics part because that is the part of the deal that should remain specific and private across the counterparties. There's also a view that we have, which is to mandate the instrument and legal entity identifiers that are already in use voluntarily today, but to have that as an ongoing requirement. Financial services firms have already built the instrument identifiers I just mentioned previously around QSIP, ISIN, and the FIGI as examples. There are others. You can make this a mandatory requirement. It's not a high cost of business for this, maybe a couple $100 or less per item issued. the cost that it takes the financial services firms to mainly reconcile is much more significant than that in the end. Um, and again, this would really be something very low cost because firms already have the infrastructure to maintain these instruments. They do it today voluntarily, and they certainly are doing it in the public market space. In the medium term, a consideration for neutrality with a private markets utility that could support common capability needs through some automation, um, standards such as the schemas we just talked about, capture reporting templates consistently across the counterparties. Certainly adding the use of standard identifiers. So you've got something special then that adds real value and improved timeliness and quality to the marketplace participants. And I think we're going to talk in a little bit about that there's a precedence already set with historically OTC derivatives, so that we know that this type of need can work and take place. In the longer term, two key needs. Kirk just talked about the payment verification, the real-time fraud detection controls. There are fraudsters that operate in the space, so being able to capture those become important, as well as conformance to the existing know your customer anti-money laundering rules. And the other one may seem obvious, yet we think it's required to expand investor awareness and training to ensure suitability, particularly for those investors that are newer to this space and aren't necessarily the institutional ones. Kirk, your thoughts?
I would just lastly say that I think that the we've put a lot of thought into this, a lot of research into this, and we've talked to a lot of different stakeholders across the limited partners, the general partners, fund administrators, custodians. We say getting closer to public markets or public markets like, but we totally understand that there are valid reasons for companies to be private and not have, say, real-time valuations. Uh, but what we're just trying to do is get standards across, many of which already exist for the public markets that can be leveraged. So we're not really asking, in our opinion, the things that we're asking Congress and the executive branch here to do, uh, um, a lot of the foundation's already built for. So it's not recreating the wheel.
Okay. Thanks, Kirk. Ashley,
Mhm.
I think back to you.
You're on mute.
Uh, Ashley, you might be on mute too.
Yep, I am. Uh, God, here we are 6 years after the push for mostly virtual and still doing it. Um, I was saying, you guys have gone through like some of the main points, and there's a lot of details in there. And for folks who are on this webinar, may or may not be familiar with, I think some of I would say the significance of some of what you're saying. So in these questions, I'm going to try to pull some of that out, but also encourage audience members, if you have questions about particular aspects of what Tom and Kirk went over or what we talk about, feel free to put that into the Q&A section. Before we go into that, we didn't really go into your background. So if you guys could both provide a little bit more of your background, you did talk about what made this topic so timely and interesting for you, but if you could also mention again, but just maybe in like one sentence, if you had to summarize it, why this topic, why now?
Yeah,
Uh,
sure. And I'm happy to start. So Tom Dunlap, my background is 36 years within financial services. I had started actually at Citibank in custody operations, and this was back in the days where there was a physical vault way below 20 Exchange Place where I began my career. But I had evolved into various different functions and capabilities, whether it's books and records, activities, general ledger functions, corporate actions, portfolio accounting, performance measurement, and so on. I then worked at Goldman Sachs for the majority of my career. That cut across spaces of ultimately heading international private wealth management operations, being accountable for Asia Pacific regulatory and tax operations, supporting operational risk management, program office needs. Also then being globally responsible for reference data operations and heading up the firm's enterprise data strategy, all while having some other jobs at the company, such as broker-dealer operations in the futures and options space. After that, I then shifted to becoming the Group Chief Data Officer at the London Stock Exchange Group. So as an exchange operator, a data procurement provider, and heavy emphasis on indices, specifically the FTSE Russell space, and oversaw the annual Russell rebalancing that I think many people will become familiar with. And then decided at that point to do advisory consulting work. And that's where I met Kirke, and we've been partners in DIACSUS ever since then. Just a couple other points to share. I've been on the board of directors of the Enterprise Data Management Council, now the Enterprise Data Management Association, a senior fellow, as Ashley mentioned, with the Data Foundation, and I've been a two-term appointee at the U.S. Treasury Department's Office of Financial Research through the Financial Research Advisory Committee. So that's the background. Why it's so relevant now. I talked about being in the vault early in my career, and all this dematerialization happened. Some of it was a bit of a shock to hear some colleagues of mine recently say that there had been an influx of physical documents for private markets instruments in a major bank's GSIB's vault, and that these are receipts, that the actual documents themselves sat with attorneys' firms, and they thought they were in the process of shutting down these vaults, as I would have expected as well. And then it just became about the opaqueness of the private market space, the need for better data governance, better data quality, and there's a spectrum on who benefits from these things, right? Who gets the outcome? Well, certainly if you move more towards private markets, that Kirke was saying, you'll get that benefit through better transparency, better clarity on the data, on the reporting, timeliness, and so on. I would argue that some institutions, perhaps law firms would be an example, tend to get better outcomes with more bifurcated billable processes. So no harm or foul to the colleagues at law firms, but there is some truth to that. So there's got to be some middle ground, we thought, within this space, and some low-hanging fruit that could make some improvements. And when the industry is asking for it, it felt that it was a call to action. Kirke?
Thanks, Tom. Kirke Cushing, and also a partner at DIACSUS. Prior to that, around 30 years experience in the financial services domain, mostly in equities, fixed income, equity and index options. 16 of those years I spent in the ultra high net worth and the high net worth area, and I culminated my career as the Chief Operating Officer of Mesirow Financial's Wealth Management Group. What is interesting to me, and I think I'll speak for Tom too, in the last 18 to 24 months, this topic just keeps coming up, and that's the opacity in the private markets, through the inefficiencies, and we just felt, there's so much discussion about this, and then we start to see the asset flows go in, and we see the rules start to change and loosen who can invest in them, and down into the retail and retirement space. And we're realizing, as Tom said, that opaque markets, and I brought up the equities and the options because back in the tech boom, we had equities were traded in fractions, and then after the tech bust, they moved into, or during the boom and after the bust, they moved into decimals. Well, that was a way of making that market more efficient, and the spreads narrower, and there were people that were making money in the fractionals that weren't going to make money in the decimals, and they kind of kicked and screamed at that time. But ultimately, the money still is made. Maybe the spread is narrower, but the quantity of trading got higher, right? So we think that you know there's opacity in these markets, and we know that there are people making money off that opacity. But we also think that making it more efficient and making it safer for investors to play in this area doesn't necessarily eliminate the ability to make money in this space.
So, Kirk, in that last section that you were mentioning of the opacity and being able to invest and all of that, the who is able to invest. Um, and Tom, you mentioned that the market is asking for it. Is that in the sense of like asking for regulations, asking for data standards so the opacity is cleared a bit? Could you just talk a little bit more about those points?
Sure. I think when I think of the opacity clearing, I think yes, because that's going to make it more efficient. But really, I think that the efficiencies are what it is going to drive the real. There's two sides to making money, as I was just saying, right? There's the expense, and then there's the revenue. So you can reduce expenses by making this a much more efficient process. Um, I think so when we say that they're asking for, it's not often that we ask for regulation, honestly, in any regulated industry, but in the financial markets for sure. This is really being driven through everything that Tom just kind of went through. It's being driven by almost all of the different stakeholders have these really inefficient processes because the data is coming in unstructured, right? These come from the limited partnerships to the general partnerships to the fund admins. All of that comes in emails or PDFs that have to be parsed, and that's brute force. That's people doing work. Generally subject matter experts doing work that they could be doing at a higher level of work if we could get standards in here so that we could cleanly automate this, right? So,
Yeah, I would just add on top of what Kirk just said that to drive better transparency and to make the processes more efficient, it's really some low-hanging fruit stuff that's out there. And the items that we covered, changes just a moment ago, um, aren't necessarily difficult to do. They're not hard to do. They're actually pretty straightforward things. What what the industry is really wanting and promoting, we know this through some of the trade associations that we're engaged with, is they want to be able to provide an indicator to the business, to the clients in the end of how's the asset performing, how is it structured, have there been changes to it through like a corporate actions event. And Kirk was saying that maybe 90 days isn't even, a realistic benchmark in some cases. Maybe it's later than that, 120 days or even longer. That's a long period to wait to determine if something has happened. And so you can build all the efficiencies as you can, but as one GSIP put it, when there are 5,000 different ways in which the data can come to them, that's really becomes hard to manage. And just imagine if you're at a firm, you had 5,000 different systems trying to capture the same information. It's logistically very difficult. So you've got workarounds, you have teams that have bespoke processes, um, limited partners trying to work with general partners to do things. And to be in fairness to general partners, the the large ones, they do have some processes that work well for them. They're just not optimized across the industry yet. And so there is a question out there around, well, who's incentivized to do this? And the incentive, we did an analysis in the white paper and we showed optically where that incentive sits. And so the ability for the marketplace participants to do this in the institutions that have to do the reporting and they have to do the performance and the portfolio accounting and so on, for them to get that information out there so that the clients know how their performance is doing, that becomes real. And then there's also the subjectivity of how these assets work, in terms of the ability to track that performance and an understanding as well. So it's a combination of multiple simple things that can take place. And when I say simple, I mean not complex from a regulatory point of view, but just practices that the industry has seen in the past.
So not um, not complex from a regulator perspective, but also not terribly complex from what is already in the marketplace and what some firms are already doing.
Right, especially, and that's some of the reference that we see to public markets. The identifiers is a great example of that, being mandatory applied there and voluntarily applied in the private market space.
Mm. Um, both you and Kirk mentioned efficiency as something that could improve through some of the short to medium term changes. Um, in this particular day and age, when people hear efficiency, they think of particular tools and technologies like AI. And you did mention something about AI compounding some of the issues that currently exist. I'm going to ask a little bit of a question about that. If an AI generated risk assessment or investor disclosure is built on unverified data, so getting at some of the issues that currently exist. So it's built on unverified data, and the report asks who owns the liability. Is it going to be the firm, the technology provider, the data source? Where do you think that liability question actually lands today, absent a standard or requirement? And why is that an important question to ask, if it is?
Uh, Actually, I'll take this, and Tom, you can augment as you see fit. But I think our point is absent a federal standard, the liability hot potato currently lands squarely on the firm, on the individual firm and its fiduciaries. And that's regardless of where the data or technology came from. And I guess how we can look at that is the SEC's 2023 guidance can be the kind of North Star. It emphasized that a firm's fiduciary duty, accuracy, transparency, and responsibility is enduring. It doesn't matter if a human or a machine made that decision. If you put your name on a disclosure built on a hallucination, AI data, you own that. You own the fallout from that, right? And I think there's, right now there's we talk about a diffused exposure and uncertain accountability in the report. It's because we don't have a mandate for data quality. Firms can't easily sue their data providers for bad inputs. And technology providers often shield themselves with as-is service agreements that might predate AI or the discussion around AI, right? And then I think today's reality is that, like I said before, without a federally mandated data standard, the firm is the last line of defense, right? They are effectively self-insuring against the risk of their own AI agents. And we argue in the report that until we have the safe harbor that Tom discussed before for standardized definitions, we're scaling that risk rather than creating efficiency.
I'd add to what Kirk said that the relevance of what you're seeing in the marketplace occurs very real. So all the firms are trying to do something with AI to improve efficiency, workflows, data matching, and so on. Yet they trust and verify. So they reconcile back the LPs, reconcile back to the GPs. They make sure that the data points are responsible and correct. So AI is a great tool to help drive you, let's say 80% of the way there. It's the last 20% that really needs to be verified and validated. And like my own personal experience is that I found that AI does the things that you want to do, yet it's not perfect. And you really do need to do a double check on the information. That's why the reconciliations exist. And that's why there's, even with AI helping with some of that efficiency, there's still a dot the I and cross the T effort taking place. And the liability on the technology itself, there are lots of tools that are out there. So it's, again, to Kirk's point, it's the firm that can choose those tools. There's a lot of data points out there, and you really should validate and know the source of the data. Data quality source is paramount. So that's why I think the firms that are really trying to be thoughtful and doing it right in this space are the ones that are doing the extra verification.
And I don't
Therefore,
want to be,
it goes back to the firm having the liability if
yeah.
they do something wrong, especially for what we call audited statements. So these are those statements, like pension plan statements, that get certified by a master custodian. That becomes very relevant.
Kirk, you were leaning in to say something.
Well, I just want I don't want to spend too much time on AI, but it is such a hot topic. I think that one thing you can think of, if done wrong, AI becomes a risk multiplier, right? Because essentially what's happening is if you have poor data because you don't have data standards, so you have poor quality data at the underlying underneath it, you have what Tom and I refer to as garbage in, garbage out, right? And so if you think about the garbage in, garbage out, and that happening at scale and at speeds which human oversight can't catch, the human oversight that Tom was just talking about, then AI actually embeds and hides or obscures the errors that could happen. And those can turn from local errors into a cascading systemic vulnerability. And I think that's really where we have to be careful. Thus, the reason you have to start with the clean data, which starts with the standards. So that's kind of
I mean, it's a really good point. Something that's very real in this space is if there is an error and it's not caught, if that error is assumed and takes place month after month after month, the longer it's been out there, the harder it is to identify when it took place and then to fix it. It's almost like any type of bookkeeping transaction where a number is netted. If that happened 3 years ago and the inputs are a high credit and an equally high debit and it's a small net amount, it may not get discovered for a long time. And time is a killer when it comes to resolving discrepancies like that.
So on that particular note, and a few other points that you guys had made of knowing, I would say something like the data lineage, and where certain pieces of data are coming from, where they're connected. Um, Tom, you mentioned the parallel to the OTC derivatives market. Um, and I just kind of piecing a few things together for, disparate information, not being connected, not really knowing where everything is, and a significant time delay within that. What, so one, can you explain that parallel a little bit, and then what lessons can we apply or should we apply to what we learned after 2008?
Yeah, that's a great point. And it was a bit of an aha moment for me as I was going through and looking at the impact of the private market space. And effectively, what had um, what had occurred is that, at least in my observation, and having lived through the financial crisis in the 2008, 2011 timeframe in particular, OTC derivatives there were known issues, and there was a need for transparency and better synergies, but each counterparty on these bilateral transactions, um, they had their own term sheet template. They had their own novation um, process template, their own fee structure, and so on. And it felt very similar to the types of documents that were required in private markets transactions. Well, the way that the industry got around us, and ISDA was a huge proponent of trade association for derivatives, but the marketplace encouraged them to do that. He said we really need to be able to have a set of standards that will make the processing much simpler. So term sheets, economic terms, novations, and so on. And what they did is they separated out the deal. This is really important. They separated out the deal economics from everything else because the deal economics were specific to those counterparties, and the counterparties wanted it that way. Well, that's similar to private markets. But that separation was key. It's something that the broader set of legal firms could agree to. And then the banks and brokers, broker dealers got behind it and they said, okay, well, then let's have some standards for the term sheets. Let's introduce a legal entity identifier. Let's introduce a unique product identifier, the unique transaction identifier. So now you begin to have some common instrument codes and common entity codes. Let's have ISTA as an NGO um, supported by regulators, develop the term sheet requirements that was born through industry input. So today, what has happened, and this is actually related to the AI question, firms have been able to figure out workflow that would do a novation match. It used to take 2 hours. They're now able to do that in a matter of seconds, quite honestly. And so the processes have become transparent and very, very efficient. Yet you're still able to have the transactions between counterparties at the desired engagement level. It's not too different from private markets and the asset classes there. So that's the synergy and the alignment. It felt very, very real and a common point there. So, how that relates to what can be done here, it was a journey. It wasn't an immediate need, but hopefully, the reasonability points that the industry is asking for here does feel that it's something of an outcome that can be achieved without too much difficulty, at least with a first pass.
Right. Um, on the note of the first pass, I'm gonna go to one of the questions submitted by an audience member. Question is the downstream challenge harmonizing and extending current standards used in public market or developing new standards? Related, is there a specific standards body or collection of bodies you're targeting?
That's a great question. So we were targeting low-hanging fruit stuff. And so there's been a lot of work in this space, to highlight let's just take the identifier standards, because that's the clearest example and easiest that comes to mind. If you think about it from the 2 points of instruments and entities. On the instrument side, as we talked about, FactSet has the QSIP, Bloomberg, through their sponsorship of Open has the Figgy, and the ISIN is part of the broader ISO and ANA set of mandates that exist, and so on. So they each come into different realms, but they exist today. I mentioned QZIP, they have something called the private placement number. It started with insurance companies needing to be able to tag similar type of private credit investments and syndicated loans and so on. They exist. Systems had been built historically years ago to be able to accommodate for special characters. ISINs have been also configured, particularly in US systems, to account for a country prefix and a check digit and so on. The Figgy had come out and is part of firms that have evolved their security master systems to contain these things. So the point is that they exist. Could there be new standards? Sure, absolutely. Some of them may come in the form of, say, payment and related fraud risk mitigants. We know that's a need. Right now, there in the US at least, it's pretty basic on ACH. It's the ABA number and the account number. There's no name matching logic. I mentioned about legal entity identifiers. That already exists through the derivatives process. Just have to pick that up. That helps with issuer entity IDs and so on. So we were attempting to identify low-hanging fruit of items that already exist. Can there be some new standards? Yes, and that's why they're more medium term, like in payments and fraud. As working groups identify our other needs, then standards could be the templating that evolves on terminology, term sheets, I mean, and so on. So anyway, I hope that's helpful and answers the question. Again, we were trying to focus on those that exist already versus creating new, although it's likely that there'll be a selection of some new standards that come.
Yeah. Picking up on those existing standards and some identifiers, you'd mentioned kind of low-hanging fruit, maybe developing something in, and also mentioned that the market is asking for some regulation or some data standards. And the other reality is that we are currently in a time where the regulators are looking at how they can decrease regulation or just not add to new regulations. So that's we'll say an interesting face to face. I'm not necessarily going to call it attention because I think it's a point for a face to face, kind of like, what is the market asking for? What is being mirrored back, and where can we go from there? But there are there are some things that currently exist that are underway, like the recent final joint rule that we saw with the Financial Data Transparency Act, or FDTA. There were a few of those standards that were agreed to across the 9 FSOC agencies. And one of those was the LEI that you mentioned, legal entity identifier. Um, how do you see, because you mentioned this in the paper, how do you see the connection of the FDTA as another vehicle for standardization, maybe as some of that low-hanging fruit where there could be agreement between the regulators who currently have things that they've agreed to and the market that might need some of that clarity?
I'll take that one. Kirk, feel free to add. I think the FTTA is a foundational, groundbreaking rule of huge importance, and primarily because what it's done is establish a set of data standards across multiple regulatory reporting agencies and types, for that matter. And the legal entity identifier being core is really, really relevant because that's a standard that's existed for some time now. It's been used by CFTC for derivative transactions, like we talked about, but it's also been adopted globally as well. That is also something that we've identified as being an important capability to link for private markets because of the issuer entity, and then also particularly for institutional entities, those firms that would be beneficial owners around traceability to understand some of the control elements that the industry is concerned about, like payment and fraud, understanding for protections, anti-money laundering, know your customer, and so on. It's important too from, let's say, an issuer perspective, because you can apply ratings to these types that firms may determine individually or through other means, suppliers of information, a type of rating or grade. I think syndicated loans would be a good example of that. And so I think that the FDTA, through its efforts, has created one point of effort that the private market space doesn't necessarily have to go through, which is to validate why should you use an LEI period. That has already happened. This is now saying, oh, and apply it to private markets as well. So I think that becomes an enabler with it, and private markets and its asset classes are another resulting outcome. Kirk, I don't know if you want to add further to that.
I would just add, I think that if there was, just to strengthen your point, Tom, if there was only one thing that Congress could do, it would be, in our opinion, the identifiers. It doesn't just make it makes it consistent across all the stakeholders and constituents that need to do anything. But also it solves, not solves, but it helps solve your KYC issues, your money laundering issues, all the fraud that can go through it. Without these identifiers, you don't know if something is being set up legitimately with all the layers in it, or if it's not. And with the identifiers, they have to go through a bit of a vetting process right there anyway. So I think if there was one thing that, and to your point, Ashley, in this area of, you know, reduced desire for regulation, I guess I'd say it. If there's just one thing that they could do, this is already out there in the public markets. It's out there in a lot of things, but this would help payments. This would help all kinds of things. There's a statistic that I still find unbelievable that we're only catching like 5% globally of all the fraudulent transactions in payments or in the financial area. 5%. That means there's 95% of fraud that is going uncaught, and I think identifiers could help severely reduce that number.
So on that, I'm gonna ask, I think, just this final question since you mentioned, fraud, identifying it, and then an association to beneficial ownership. The question is maybe, let's see, you identify beneficial ownership and fraud or payment integrity as an industry issue. Can you clarify on efforts to the extent they exist to standardize approaches to describing beneficial ownership? I think the
Yeah,
definition
so
and description of beneficial ownership.
right. So that's a great question. So Kirk and I have also worked in the payment security space, and we know that within the U.S. marketplace that um, having a set of standards around prepayment verification around the customer and the payee is not a strong capability that exists with many providers in the marketplace. I think some firms are trying to create that, and other firms are looking for vended solutions. And there are different approaches to how that may take effect. Yet still, being able to have a standard apply, which one does not exist today. Yet again, I think the industry is working towards it, does help with respect to identifying and linking, let's say, to the LEI, to other different sources of IT information that can validate and verify, some of the other aspects related to private markets, such as KYC, AML rules, and so on. It's pretty interesting that even in spaces like in predictive markets, some of the operating exchanges are considering transactions depending on how private markets may perform. So just think about derivative transactions. Will this private market space, a private equity investment that just took something from public to private, will it succeed or not? Then, it becomes relevant, around the transaction trail to understand whom ultimately is part of that transaction for reporting purposes as may be required through different regulatory disclosures. So that would be an example of how the industry continues to evolve in that space. That's my take on it. Kirk, if you want to add to it.
I just think that what Tom just said, and he said it more eloquently than I was trying to, is it shows how interconnected everything within our financial markets is globally, and how one broken link in the chain can really create havoc. And the idea behind us talking about private markets now is really because we would prefer to get ahead of a disaster that in the marketplace, as opposed to trying to, as I say often, sit in that Lehman Brothers conference room for a 3-day weekend trying to figure everything out and put it all together. If we have them all identified beforehand, it's easier to fix.
Yeah, I mean that's actually a very real and great point. Just it wasn't that long ago that we had the financial crisis, and that's the reason why one of the reasons why the LAI even came to place was to be able to track and identify entity tree structures. Well, an involvement of that are the beneficial owners as well. Private markets hasn't been tested for a major disruption event. We've not really seen it happen since all this investments come into the space. You want to make sure you have all the protections that are possible to ultimately know transactions, ownership, beneficial requirements, so on. And I think everyone on this discussion can read reports and the news articles as well as we can, but the private credit space has some risk right now.
$15 trillion
Where
is a
where
big
does it
number.
stand? It's a huge number. Yeah.
I think it's the
And
GDP of China, I think. I think it's big.
is that all? Um, all right. I think that's a good note to end on. I think it's kind of that again, reiterating why is this important? Why are we talking about it now? It is a little bit at the forefront of the conversation, but at the same time, like we're seeing this conversation within private markets kind of rise to the top, and it would be better to talk about it and address it now, Kirk, just as you were saying, to address it now than have what would probably not be a 3-day weekend. It would be a 3-week
It'd be something.
weekend or
It's just
something like that. And so many things are digitized and integrated now, that, let's apply some of those lessons learned. Thank you guys for talking. I'll just go ahead and close this out, and repeat, that you can get a copy of this paper and a briefer on our website. It's been included also in the chat here. We'll follow up with those links. I'll make one plug on our behalf is that we are soliciting for Datum Award nominations. Those nominations will be closing in 2 days. So end of day, July 17th, this Friday. And for who you can nominate, those are folks that were affiliated or in government at the federal level. I think for the last year, for the specifics on that and who has been nominated in the past, you can look on our website. We would love to celebrate some of these data champions who are working on topics like this, who are working to actually address some of the informational we needs to connect the dots, and are doing so very well. So thank you all for being here. Thank you for your afternoon, and we'll be in touch.